Is the trade desk currently in, like, a terrifying free fall, flashing massive sell signals across the board? Or is it the ultimate undervalued strong buy opportunity of 2026?
Yeah, I mean, that is literally the multi-billion-dollar question dividing the market right now. And honestly, the answer depends entirely on whether you are looking at the company's past or its, very precarious future.
Right, because today is April 16th, 2026, and the trade desk, ticker symbol TTD, has just closed at $22.76.
Let that sink in.
I mean, it's wild. This stock is down a staggering 40.04% year-to-date, and it's hovering dangerously close to its 52-week low.
It is a brutal chart to look at.
It really is. So we are going to look at the cold, hard data today in this deep dive. We're opening up the financials, analyzing the charts, tracking the insider flow, and pulling apart the analyst debates to figure out what is really going on.
Exactly. But before we pry open the vault and look at the numbers, do us a quick favor. Hit the like button, subscribe to our YouTube channel, and leave your comments below.
Yeah, honestly, it's compulsory if you want to keep getting these deep dives. We basically rely on your feedback in the comments to dictate what stock we investigate next.
And the comment section on this one should be explosive, just considering how polarized the market is on this specific company right now.
Oh, it is pure chaos. I mean, I am looking at this chart right now, and the contrast between the current pessimism and where this stock was recently is just almost unbelievable.
Right, the highs were massive.
Yeah, the 52-week high is $91.45.
Yeah.
It has plummeted from over $91 all the way down to $22.76. As someone who watches these markets, I naturally want to know how a supposed market darling falls so far, so fast.
Well, a stock doesn't lose that much of its value in such a short window without, a fundamental reassessment by the institutions holding it. The narrative just shifted with violent velocity.
Yeah.
The core thing you have to ask yourself as an investor is whether this massive repricing is based on a fatal flaw in the actual underlying business, or if it is just a panic-driven overreaction in the stock price itself.
Okay, so before we give in to the panic of a 40% drop, I think we need to see what the business is actually doing. Because looking at the stock chart feels like watching a car crash in slow motion.
Right, it's ugly.
But when you look at the balance sheet, it's like opening the front door of a burning building and finding a perfectly intact vault full of cash. It tells a completely different story.
That is a great analogy. The disconnect between the market sentiment and the trailing financials is one of the starkest we've seen this year.
Let's dig into the actual numbers then.
Yeah, so if we take the trailing 12 months leading up to April 2026, total revenue didn't shrink. It actually went up. They pulled in $2.90 billion compared to, $2.44 billion back in 2024.
And it's not just the top-line revenue growth, right? The profitability metrics are frankly absurd for a stock taking this much of a beating.
Totally.
Their gross profit over the last 12 months is a massive $2.28 billion. That translates to a 78.6% gross margin.
Which is huge.
Yeah, I mean, you just don't see margins near 80% in companies that are supposedly falling apart. Plus, operating income sits at $589.32 million, and net income is highly solid at $443.30 million.
Giving them a diluted earnings per share of 90 cents.
Exactly.
To put that 78.6% margin into perspective, it indicates incredible pricing power and an intensely scalable business model. Because the trade desk operates a programmatic advertising platform, which is essentially software that automates ad buying, every new dollar of revenue costs them very little to process.
Right. They don't have massive manufacturing plants or supply chain bottlenecks to worry about.
Exactly. They have servers and code. And that efficiency just bleeds right onto the balance sheet.
Well, and the balance sheet is an absolute fortress. Total assets are sitting at $6.15 billion against total liabilities of $3.67 billion.
But the liquidity is what really jumps off the page there.
Oh, for sure. They are sitting on $1.30 billion in cash and cash equivalents. Compare that to their total debt, which is only $436.33 million.
Oh.
Yeah, they could wipe out every cent of their debt tomorrow morning and still have nearly $1 billion sitting in the bank to just weather the storm.
And they're continuously replenishing that bank account, too. Over the trailing 12 months, they generated $992.72 million in operating cash flow.
So nearly $1 billion in pure cash generated from their core operations.
Nice.
Wait, hold on. I have to challenge this premise.
Okay, go for it.
You are painting a picture of a company with 80% margins, swimming in $1 billion of cash, generating another billion a year, and facing zero debt risk. Wall Street isn't stupid.
Right.
So if the underlying business is literally a cash printer, Why are institutions dumping this stock by the millions and treating it like a distressed asset?
Because Wall Street is a forward-looking, forward discounting mechanism.
Hmm.
They basically do not care about what you did yesterday. They only care about what you will do tomorrow.
Okay, so the cast doesn't matter.
Well, the financials we just discussed, that pristine balance sheet, is a trailing indicator. It tells you what the trade desk has already accomplished. Wall Street is currently panicking over the future.
Ah, I see.
When a stock is priced for perfection, as this one was at $91.55, it is carrying a massive growth premium. If the market suspects that future growth is going to stall, they strip away that premium aggressively.
That clearly brings us to the actual price action. Because Wall Street obviously doesn't believe those trailing financials are going to last.
No, they don't.
You can see that panic materialized in the order flow. I mean, if the underlying financials are a fortress, the technical chart is just a horror movie. Let's look at the technical analysis to understand why sellers are in complete control right now.
Yeah, the technicals paint a pretty grim picture. The trend direction is deeply bearish. The stock is currently trapped in a multi-month falling trend channel.
What does that mean for people who aren't looking at charts all day?
Think of a channel like a set of stairs heading down into a dark basement. Every time the stock tries to rally, basically taking a step up, sellers immediately step in at a lower high and push it down to a lower low.
So the momentum is firmly in the hands of the sellers.
Exactly. The buyers have completely lost the ability to dictate price.
And when you try to find a floor on this chart, it gets even scarier. The current price lacks any strong horizontal support because it's trading near multi-year lows.
Right.
We keep hearing analysts throw around this 52-week low of $19.74, but that isn't structural support, is it? It's just a psychological number.
Yeah, exactly. Structural support is created by historical memory. It forms when there is massive trading volume at a certain price level in the past where buyers consistently stepped in and accumulated shares.
But it hasn't been down here in forever.
Right, because the trade desk hasn't traded down in the $20 range in years. There is no historical memory of buyers defending this specific zone. So $19.74 is just a number on a page marking a recent bottom.
Meaning, if it breaks below that, what happens?
If the price breaks below that, the stock enters what we call price discovery mode. It falls into a void until it finds a price where new buyers are finally willing to step in, which is highly volatile.
Meanwhile, if it tries to go up, it hits a concrete ceiling almost immediately. There is a massive wall of resistance at $44.50.
Yeah.
And it is trading far below both of its key moving averages, right? The 50-day simple moving average is at $24.47, and the 200-day is way up at $44.47.
Those moving averages act as dynamic resistance. The fact that the 50-day is so far below the 200-day, which is a classic bearish signal, just confirms how deep this downtrend really is.
We can also look at the MACD, right?
Yes, the MACD basically tracks the relationship between two moving averages to show us the acceleration of momentum. Right now, the MACD is deeply negative. It's telling us the sellers aren't just in control, they're accelerating.
And the order flow data shows liquidity is currently bunched around a very tight daily range of $22.50 to $23.39.
Exactly.
But wait, here's a massive detail. The RSI, the Relative Strength Index, is currently sitting below 30. For anyone tracking technicals, below 30 officially means the stock is in oversold territory, right?
Yes. It does.
So if a stock is that deeply oversold, doesn't that mean the selling has gone too far, too fast, and we are due for a massive snapback rally?
Well, that is the exact assumption that traps thousands of retail traders every single day. Yes, RSI below 30 indicates the selling has been extreme.
So why wouldn't it snap back?
People love to compare an oversold RSI to a stretched rubber band, assuming it just has to snap back. A better analogy is like a compressed spring in a machine.
Okay, I follow.
If the machine's suspension system is broken, meaning the company's fundamentals are deteriorating, that spring won't bounce back. It just gets crushed and stays compressed at a much lower level.
Wow. So an oversold signal on a chart doesn't actually mean the downtrend is over.
It rarely does in a strong downtrend. You have to understand the dangerous difference between a short-term relief bounce and a true trend reversal.
Which we sort of saw recently, right?
Yeah, we did see a minor recovery of plus 1.70% in the latest trading session. That is likely your relief bounce. It's just short sellers buying back stock to lock in profits or trading algorithms automatically buying because the metric hit an extreme low.
Right.
But a tiny 1% bounce does not break a medium to long-term falling trend channel. Until the stock actually starts making higher highs and higher lows, the trend remains bearish no matter what the RSI says.
Okay, so the technicals are screaming sell, while the trailing financials scream strong. But what are the actual architects of the company doing behind closed doors?
Oh, this brings us to a wildly polarizing tug of war among the insiders that is playing out right now.
Yeah, this is perhaps the most fascinating part of the entire situation to me. You have two very different signals coming from the absolute highest levels of the boardroom.
It is the ultimate high-stakes showdown,
Seriously, on one side, you have the CEO, Jeffrey Green. He recently bought an astonishing $150 million worth of stock.
which is just unheard of.
We are talking about roughly 7.16 million shares purchased in the open market in the 90 days leading up to April 11th, 2026. He just pushed $150 million of his own ships to the center of the table.
Yeah, it is really important to understand how rare that actually is. Most tech executives acquire shares through stock options or, standard compensation packages.
Right. They get it for free, basically.
Exactly. They rarely take their own personal capital and buy shares on the open market. A CEO making an open market purchase of $150 million is basically screaming to Wall Street, "You have priced my company incorrectly."
It is a massive, highly public vote of conviction in the long-term viability of his business.
Absolutely.
But then, while the CEO is aggressively buying, you have a key director who just sprinted for the exits. Director Catherine Fellberg unloaded 4.66 million shares in early March 2026.
That is a lot of shares.
That sale was worth approximately $141 million. So how are you, as an everyday investor, supposed to interpret these radically mixed signals? The CEO buys $150 million, and a director sells $141 million.
When analyzing insider action, there is an old Wall Street adage you have to keep in mind. Insiders sell stock for a dozen different reasons, right? Buying a new estate, tax liabilities,
Yeah.
basic portfolio diversification.
Sure, that makes sense.
But they only buy stock for one reason. They think the price is going up.
Right.
However, a $141 million sale by a sitting director is far beyond standard diversification. That level of selling suggests a deliberate desire to significantly de-risk her personal portfolio ahead of potential turbulence.
And it seems the smart money is leaning heavily toward the director's perspective right now. Looking at the institutional flow, the big whales are leaving.
Yeah, they are.
Net institutional holdings have dropped by 11.54% in the latest reporting period alone.
Which is the really critical data point here. Institutional capital, like the mutual funds, the massive hedge funds, that is what drives sustainable trends in the stock market.
So retail traders can't really fight that.
No, not at all. If institutions are actively rotating out of the stock, shrinking their exposure by over 11%, a single CEO's purchase, even at $150 million, isn't enough to absorb that massive wave of selling pressure.
Ah, that explains it.
Yeah, it explains perfectly why the stock remains trapped in that downward technical channel despite Jeffrey Green's profound conviction.
Well, that split in the boardroom perfectly mirrors the war currently raging among Wall Street analysts, too. The core debate right now is whether the trade desk is a once-in-a-decade value play or a classic, highly dangerous value trap.
Let's define those terms clearly for everyone. A value play is a fundamentally strong company trading at an irrational discount because the market is just overly fearful.
And a value trap.
A value trap is a company that looks cheap on paper but is actually priced correctly because its core business is permanently deteriorating.
Let's look at the current ratings then. The consensus among analysts right now is a moderate buy. That is broken down into 13 buys, 14 holds, and 3 sells.
Yeah.
The average price target they've set is $31, which implies about a 36% upside from where we are sitting right now at $22.76.
So the bulls are obviously looking at this roughly 50% drop from the highs and seeing a deeply undervalued asset,
Yeah, they point to a PEG ratio of 0.86.
which is low. The PEG ratio, or price to earnings to growth ratio, is a metric that factors in the company's expected growth rate alongside its earnings.
And anything under 1.0 is considered undervalued by traditional metrics, right?
Typically, yes, that's exactly right.
The bulls also look at the forward PE, the price to earnings ratio, based on next year's estimates, which is sitting at 17.89.
Which doesn't seem too crazy for tech.
Exactly. You combine a forward PE under 18 with those 78% gross margins, the $1 billion in operating cash flow, and the CEO's $150 million buy, and the bulls are pounding the table saying this is a no-brainer.
The bear case, however, is looking at severe structural cracks forming in the foundation. The skeptics focus on the trailing PE, which is higher, at 25.34. But more importantly, the bears aren't just arguing about valuation multiples. They are pointing to fundamental risks developing right now in the company's ecosystem that threaten to choke off that cash flow entirely.
And these are not minor risks. The sources highlight that revenue growth is moderating down to the 15 to 20% range. There have been major guidance misses recently.
Yep.
Furthermore, there is a massive executive exodus going on. We are talking 3 key departures in the month of April alone.
That is a lot of turnover very quickly.
On top of that, they're facing intensifying competition and ongoing, highly publicized disputes with major ad agencies like Publicis.
The Publicis dispute is really critical to understand. Ad agencies like Publicis act as the gatekeepers for billions of dollars of advertising spend. They represent the world's biggest brands.
So they control the actual money.
Exactly.
Yeah.
If the trade desk is engaged in a dispute over fees or platform control with these gatekeepers, Publicis can easily just steer their clients' ad budgets to competing platforms.
So if you fight the gatekeeper, your revenue pipeline just dries up.
Precisely. Combine that threat with growth slowing to 15%, and the valuation argument shifts entirely. The trade desk used to be priced as a hyper-growth tech disruptor. But if growth is stalling, it must be priced as a mature, slower-growing company.
That transition is brutal, and I have to push back on the bullish valuation metrics here.
Let's hear it.
A forward PE of 17.89 sounds great on paper, but does paying any premium make sense if your core growth engine is slowing down? You're alienating massive ad agencies that control the money, and your leadership team is suddenly heading for the exits.
It's a tough sell.
3 executives leaving in a single month isn't just standard turnover. That is an exodus.
It is a massive red flag.
Yeah.
When key leadership abandons ship during a period of slowing growth and missed financial guidance, the market naturally assumes the worst.
Because they know things we don't.
Exactly. Executive turnover breeds intense uncertainty. It makes analysts wonder if the internal projections the executives are seeing are actually far worse than the public guidance the company released.
So what does this all mean for you listening right now? With both the bulls and the bears making incredibly compelling arguments, we have to look at the immediate road ahead.
We really need to clearly map out the scenarios from here, specifically the dangers for everyday traders trying to navigate this storm.
Okay, let's start with the best case recovery scenario. That relies heavily on those oversold technicals sparking a rally, right?
Yes, but that rally must be immediately validated by strong fundamental news. Specifically, management needs to deliver a blowout quarter that completely resets the narrative.
Which brings us to the ultimate short-term catalyst, right? The Q1 earnings report looming on May 14th, 2026.
That's the big date.
Analysts across the board are urging extreme caution ahead of this specific date.
Because the downside risk is severe. The worst-case scenario is a continuation lower. If the upcoming earnings disappoint, or if their forward guidance is weak again, that $19.74 psychological floor we discussed earlier will likely shatter.
And if it breaks?
If that level breaks, we could see a technical freefall as automated stop losses are triggered and the remaining institutional holders finally capitulate and just sell at any price.
Wow. It is so tempting to jump in, though. Thinking like a retail trader right now, I look at this and my brain just screams, discount.
Right, because of where it was.
Yeah, you see a company that was $91 now sitting at $22. But stepping in front of a freight train just because you see a penny on the tracks is how you get crushed.
Exactly.
How much of this current price action is just pure irrational fear versus a calculated permanent repricing of the company's future?
Well, what's fascinating here is how behavioral psychology traps retail investors. It is a classic case of anchoring bias.
Meaning you get stuck on an old number.
Exactly. You are anchored to that $91.45 price tag. You view the current $22.76 price not for what it represents today, but simply as a massive discount from the high.
Which is a dangerous way to trade.
Incredibly dangerous. Because the market isn't irrational for selling a stock that is suffering from slowing growth, an executive exodus, and structural disputes with its biggest partners.
So the retail trap is just buying blindly.
Right. Buying simply because a stock is quote-unquote down 40% while completely ignoring the downward momentum on the chart, the fact that institutions are selling, and the fundamental deterioration of the business.
Yeah, that makes a lot of sense.
In the short term, pessimism and fear are the dominant emotions driving this price. In the long term, recovery depends entirely on management's ability to stabilize the ship, replace those executives, and basically re-accelerate their revenue growth.
Well, we have covered a massive amount of ground today. We opened up the pristine balance sheet, we looked at the ugly reality of the technical chart, we analyzed the high-stakes insider tug-of-war, and we previewed the looming earnings report.
You hit all the big points.
We did. But before we wrap up, we must explicitly remind you that this deep dive is a natural human debate exploring financial data and market psychology. It does absolutely not constitute financial advice.
Exactly. You have to do your own research and fully understand the risks before deploying your hard-earned capital. We are here to synthesize the data and explain the mechanics behind the moves, not to tell you what to buy or sell.
Couldn't agree more. And I want to leave you with a final thought to mull over. With Q1 earnings looming on May 14th, the ultimate question isn't just whether the trade desk can bounce off its 52-week low on a stock chart.
No, it's bigger than that.
The real question is, has the digital advertising landscape fundamentally shifted away from them while we were all distracted by the stock price?
That is the real danger.
If CEO Jeff Green is right, it's the buy of a lifetime. But if the bears are right, $22 is just a pit stop on the way down to a much, much lower valuation. Which side of the trade would you rather be on?